Okay, we'll go ahead and get started. My name is Alex Oliver. I'm a financial advisor with First National Corporation, and this is part of our financial boot camp series with Schwartz and Schwartz Accountants. We've done several of these over the last year or so that you can find at the Schwartz Accountants website/events. I'd encourage you to go there because we've discussed many things such as college planning, other retirement planning topics, investment and economic overview, and so there's a wide array of things there. I'm sure we'll have a Social Security webinar up there in the near future. So a lot of resources for you. I'm going to be talking at a high level today in regards to planning for retirement, the steps to consider when planning for retirement. And I hope you'll have a lot to take away from this. We'll be starting with some of the softer aspects of planning for retirement, but then, as you can imagine, from a investment advisor's point of view, taking a lot of the look at the financial and tax consequences that go into this, just to give you some thoughts as to the last maybe 10 years or so of your working life to make sure you're well positioned to head into retirement. I do think we have some people that are registered here today that are maybe more than 10 years from retirement, and that's okay. I've got some material here for you as well, such as benchmarks to consider along the way and how much you should be saved up to right now. And so that's okay. Stick around for that. Otherwise, we'll definitely be focusing on those last 10 years. Just to give a brief introduction, if you've seen my webinars before, you already know this, but as a little reminder, First National Corporation, we're a registered investment advisor down in the South Shore of Massachusetts, specifically Rockland, just outside of Hingham and Cohasset. We have two sides to our business. One is on the wealth management side, which is where I spend most of my time as a certified financial planner, working with a little over 100 families and essentially acting as the quarterback to their financial lives, managing their investments and implementing a tax plan, which we do in conjunction with the Schwartz and Schwartz accountants. On the other side of our business, we have a complete fiduciary practice where we essentially are the advisor on 401k plans, simple IRAs. We work with profit sharing plans, cash balance plans. So small businesses from say 5 to 10 employees to businesses that have hundreds of employees, where we're, again, the quarterback of that relationship, managing their 401k plan. A lot of the younger folks that we work with start with us in that side of the business, implementing their plan, and then eventually end up migrating to our wealth management side. So that just gives you a little perspective on where we are. Before every presentation, I'd like to just throw up this disclosure that I'll be sending out a lot of opinions, maybe giving somewhat advice for certain age demographics, but obviously realize that everything I talk about today has no understanding of the attendees' life circumstances or preferences. So the general principles that I discuss, I would not encourage you to constitute that as personal advice. I'd encourage you to talk to somebody a little bit more one-on-one before implementing anything here. But again, I think that this presentation will at least make you aware of a lot of areas that you may not have considered thus far. Okay, so let's just talk a little bit about retirement as a whole. Again, these first 10 minutes here or so, I just want to get the philosophy of retirement down, because retirement looks very different for every couple or every family that I work with. And specifically, I think, as we found out, that our retirement ends up looking a little bit different than, say, our parents' retirement did, or even our grandparents did, because a lot of things have changed over the last 30 or 40 years. And I think I see that perspective maybe not being completely realized as people start to save for retirement and prepare. This just goes over, what people after age 65, what do they typically say they're going to do? To some degree, I think they're pretty well aware of what retirement looks like, because the top two answers to this question are typically travel, number one, and work, number two. Okay, that's probably not a big surprise. But again, a big difference from how your parents or how your grandparents probably lived in their retirement. They probably didn't travel as much as you think that you might. Travel has certainly become much easier in 2018. You can get to places much easier, much faster, and much more cheaply. But because people have the aspirations to travel around the country or travel out of the country, there certainly is more expense to that. Previously, people in retirement would really stay in one place. So that certainly has to be taken into account. And then on the other side of the coin, people, again, realize that and think that they need to continue to work throughout retirement because they haven't saved up enough. And we'll talk about why that is. Again, that's likely not exactly how your parents had to live, because they may have been able to rely on a pension or Social Security more than you'll be able to. So let's just keep that in mind as we go through here, that we really need to rethink retirement as a whole versus maybe how we've experienced it with family members in the past. So again, staying with some of the soft aspects of retirement here first, there are three questions. I sat in on a presentation from the MIT School of Engineering once. They have this age lab where they really discuss and study retirement as a whole. And I liked these three questions. They're very memorable. They're a little silly in some respects, but when you think about it, and again, you think about how retirement's going to look, I think they'll really stick. So the first of our three questions, who will change my light bulbs in retirement? This is really trying to emphasize the point, well, if you were going to be living in your house, which is going to be your largest expenditure, due to all the maintenance in that house, if you have a really old house, all the utilities, all the work that goes into that, eventually as you get older, you'll likely not be able to do all the things around the house that you previously were able to, even if it's as simple as mowing your lawn. Again, that might be something that you may not be able to do. So as we're preparing for retirement, are we thinking about this home as the place that we're going to be living in for 10 or 15 years? If so, thinking about putting different modifications to the house in place, using things like certified aging in place contractors to remodel the home and make it, say, more accessible on the first floor if your bedrooms are currently on the second floor. Again, that might be an expense that you want to consider as you go into retirement. For some people, 40% of women, it says here, will be living in their home alone once they get over the age of 65. And that number is rising substantially. Obviously, let's all remember that men usually pass away before women, which leads to this statistic. I think the divorce rates of people over the age of 60 have skyrocketed in the last 5 to 10 years. So that also leads to this sort of statistic rising. So if you're, in one of those positions, how are you going to pay for all these things again within your house if someone that maybe you were depending on to take care of a lot of this is no longer there? So just, again, some things to think about. And then finally, I just also bring up that in retirement, again, if you think about your parents, you may have lived a lot closer to your parents when they retired than your kids are going to live to you when you retire. So in the past, we might have been able to rely on kids to come and take care of some of the simple things like changing light bulbs. But if they're more geographically distant from you today, that again might be something to consider here. So just some things in regards to the housing portion of this. Our second, again, sort of silly question, how will I get an ice cream cone? This is just talking about how am I going to actually get around? How am I going to be mobile? I will say things like Uber have really changed the dynamics of retirement for the better. So if you're approaching retirement, I'd get very versed on how to use that service to get around. But where am I going to be located in order to be able to get to the things that I like to do? When I'm in retirement, I've got some of the 8s in here that we discuss. Where do I like to congregate, recreate, educate, and donate? So where am I going to be spending my time? Again, this also might be coming into the housing discussion as to whether I should stay in my house or move out of it to somewhere closer to where I want to be. And this inevitable point here as far as losing your license, again, as I mentioned, a lot of people are using Uber to get around these days, but kind of just realizing that at some point in time, you're not going to be able to get to the part of town that you usually are able to. How am I going to plan for that? Again, this might seem really well in advance and like a really far off concept right now to be thinking about, but it is just something, again, I want to bring up as we go through some of the financials here in a little bit. And then finally, who will I have lunch with? I think a lot of the families that I speak to have these dreams or aspirations of moving somewhere warm, going to a completely new state like Florida or Texas or even somewhere internationally, and deciding that this is where I'm going to be spending my retirement. I've also seen a lot of cases where people might do that for 5 or 10 years and decide that they end up wanting to come back. And that may either be part of the plan or that might end up being a plan that comes into place much later on. I will say that studies have shown that women tend to have a much easier transition process in moving to a new place. They typically find their friends or people that they're going to socialize with in other social networks around town, whereas men typically spend a lot of their time building their social networks within the workplace and have a little bit of a harder time making that transition. So before, really thinking about selling your house and moving to a completely new area, I would try walking that out. And that might mean renting in the new area that you're going to be, or spending some summers in those areas or some extended time. before investing a whole lot of money in a new condo or new vacation home or whatnot. So again, just three questions to think a little bit about: how is retirement going to be lived before we get into the financials, because we can talk all day about the financials and how to extend your money, but it's really going to be a reaction to your overall life plan. And the more sure that you can get around your life plan, the easier it's going to be to plan these next aspects. Okay, so just with that kind of introduction, let's talk a little bit about how to plan for retirement, whether or not we're on track right now, strategies to get back on track, and if we are on track, just other considerations that we might have in mind. So this slide here is a little bit busy, so I'm going to leave it up here for a couple of minutes, but just to explain it, we have some checkpoints along the way, just to give you an idea as to where you should be at a certain point in time. I'll roll with this $100,000 household income just for easy math, but the way you want to read it is where you and your spouse combined make right now. So let's just say you and your spouse combined make $200,000. You'll use this column right here, and then go down to the age that you and your spouse are currently at. Obviously, you might have a difference of age, so take roughly the average. If you are 50 and your spouse is 60, use the age 55 column, and then combine your assets to see where you're at. So if we take the $100,000 range, someone that is at age 30, according to this chart, should have 1.3 times this household income. 1.3 times the 100,000 would say that we'd have around $130,000 in combined retirement assets. And that would tell us that we are on time for retirement. If we go all the way to the end here, someone with $100,000 of combined income should have roughly 7.3 times in total retirement assets, so around $730,000 by the age of 60, to say that we're on time for retirement. So a couple of comments I want to make, again, as you might be looking at this chart and making the own calculation for yourself. A couple things would be that if we're in these lower income tax or these lower income brackets, notice that these multiples are much lower than if we get over here. Same age, but much higher income requires having much more money to be on pace for retirement. We'll talk about why a little bit more in detail, but just remember that the way that retirement has changed over the last 20 years is that we don't have a lot of income sources to rely on, such as Social Security, which was more generous in the past, or pensions, which were much more generous in the past. And so a higher income person not only does not have access to those guaranteed income streams, but also is in a higher tax bracket. And therefore, when they're taking their withdrawals, they'll be paying more in taxes as they go along here. So this chart actually comes from JP Morgan, from a very intense study to see what are the lifestyles and situations of a $200,000 household versus a $300,000 household, taking into account their typical Social Security benefits, taking into account their tax brackets, along with assumed investment rates. I believe it's a 5% investment rate of return during retirement, which I think is reasonable. And this would just give you an idea as to how much you might need during that time. This is a general number, though, so we'll continue along here to give you maybe a little bit more of an idea as to where you stand. But just to parlay on that conversation a little bit further, this is talking about the sources of income that people will typically have. And, I think this is really a more of an average American chart, and maybe not fitting the demographics of this presentation today, where I know a lot of medical professionals are working with Schwartz accountants and maybe making much more than the average American. But the average American might have a lot of their income, 38% coming from Social Security, 23% coming from a paycheck, which means that they're still working, about 18% from savings and investments. And then we used to have pensions here, but I've kind of X'd this one out because, again, that's really not a factor in today's economy. But instead, again, for this audience, I've also put in business proceeds. So if you've got your own dental office or your own one-person office here, and you're going to end up selling that for some certain amount of money, a lot of this population will end up using those proceeds to get through the first few years of retirement, which, again, we'll talk about here in a moment. So just trying to plan out those different buckets to figure out where you're going to be is incredibly important. I will say now that it's crucial that at some point you go on to this website, ssa.gov, which is the Social Security Administration, to get an idea of what your benefits are going to be, but also ensure that they have your earnings record correct. Again, I can do a whole presentation on Social Security, but just remember that your benefit will be based on your top 35 years worth of earnings. And if you've earned over the Social Security wage base for all 35 years, so if you're in the medical profession and you've been making well over $150,000 per year for most of your life, you'll have the maximum benefit, which will be somewhere around $40,000 per year. If you and your spouse both did that, that might be around $80,000 per year. And that's a nice top line number to know, but again, we'll have to remember that it's eventually going to be taxed at a much higher rate than others. So I think the basics of making our retirement plan start with knowing what is the Social Security benefit. Again, for most people in this presentation, you'll want to wait until age 70 to take that benefit because you'll get those guaranteed increases of 8% from your full retirement age to age 70. So it's very, very, very rare that I would ever advise a client to take their benefits before age 70, especially again for this audience. So then the question will eventually become, well, how do I pay for retirement if I'm going to retire at age 60 or age 55, but I'm waiting for my Social Security at age 70? And again, we will talk about that as we go through this presentation. Okay, so just getting some general ideas. I showed you some general numbers earlier, just based off your income. This might be a little bit better of an analysis if you want to do this on your own to figure out what am I going to need for retirement. There's a very important withdrawal rate rule that you should know about if you don't know it already, which would say how much can I take from my investments every year in order to not run out of money, okay? There are basically three numbers that people use, a 4%, a 5%, or a 6% withdrawal rate, meaning that if I have $1 million and I take 5% out, that means I'm taking out $50,000 per year to live off of. Now, if me and my spouse have $20,000 from Social Security, that means we're living off of $90,000 per year. So let me just explain the withdrawal rates, and then we'll just go through the quick math. Typically, studies have shown that a 6% withdrawal rate will mean that your money will run out in about 30 years. So for a lot of people, a 6% withdrawal rate could work. You think about it, if you retire at age 65 and you go to age 95, a lot of us will kick the can before age 95. And so if we run out of money by then, we will probably be okay. I tend to not want to advise my clients to be on that plan and have that little bit of uncertainty. So typically I'm advising a 5% withdrawal rate. But you can also get really conservative and say, I'm only going to withdraw 4% of my investments. And that is a traditional, again, studied mark that says if you only withdraw 4% of your assets every year, on my $1 million, I only take $40,000 out, that my money should not erode principal. I should be able to take $40,000 out, but that $1 million will be able to earn more than 4% that year, maybe earns me 5%. So I take out $40,000, I earn $50,000. At the end of the year, I have $1.010 million. So I don't erode that principal, and therefore it will be impossible for me to run out of money. So you or your financial advisor will have to decide what is the right withdrawal rate for you. You might have a bigger withdrawal rate in your first 10 years of retirement while you're traveling and still able-bodied to be able to enjoy life, and then maybe lower that spending over time. So it doesn't have to be a flat 4 or 5%, especially if you're cutting it close, but you just have to have a plan in place. To briefly explain how you might come to your round number of what you need to have for retirement, I've just kind of given a quick example to say if you and your spouse are currently at $150,000 worth of income, you might plan on spending about 75% of that during retirement. Again, another studied number that is a rough calculation. If you could be making, $1 million per year and be very frugal and only spending $100,000 currently, I've got a lot of clients that make a lot of money and really stay very frugal. They still only buy Toyota Camrys and, they live in a very modest house. So these aren't always the greatest metrics for everybody, but it's a nice general idea that about 75% of what your income is going to be spent in retirement. So I say we need about $112,000 in annual income need. Maybe you'll get about $40,000 in Social Security benefits. Again, if you're higher earners, it might be more than that. If you're lower earners, it might be less. That gives us a need of about $72,500. you can simply divide that number by 0.05, which is our 5%, and that will give you that round number. This is what I need in order to say I've got a safe amount of assets to be able to retire on. Again, this is a quick analysis. We definitely make this much more complicated and look at a lot of more factors when we're working with a retiree. But again, if you're not going to work with a financial advisor, I want to give you an idea or a resource to look at. As you're planning out how your retirement plan is going to be put in place, I like to just throw in this slide that says, be careful about reading certain things on the internet that might not apply for you. I mean, there is no lack of financial advice out there. Some of it is from more pure sources than others. But as an example, I definitely see a lot of retirees who, for example, get sold a whole life insurance policy that probably didn't need it. Or I see a lot of retirees who get sold an annuity that don't completely understand how it works, or maybe they didn't even need that as well. So I just, again, want to kind of put this in here to say that, annuities are not a bad product, but they're just not for everybody. Reverse mortgages, not a bad product, but not great for everybody. And then even in regards to the investment side, which is where we spend a lot of our time, there are some general metrics out there to say how much of an equity exposure, how much in stocks you should have versus fixed income or bonds. Generally speaking, again, your equities should be going down as you get older, so that way you're maybe at a 60% stock, 40% bond allocation when you're age 65. But even that, I would say, is very general and not quite appropriate for everybody. If you think about it, first of all, fixed income instruments have not really provided us a lot of income over the last 10 years. So your savings and checking accounts, your CDs, your bonds that you've held have not yielded the required 4 or 5% return in order to sustain a retirement spending lifestyle. But equities have done well, and those equities do pay out dividends. So maybe it's more appropriate to have a higher equity exposure with dividend paying stocks. That's just one really quick example. Another example might be that if you find yourself with much more in retirement assets than you'll ever spend down, you may be able to take more risk than someone otherwise would be able to, because if your assets drop in the short term, it won't affect your spending at all. And you'll know that you have 20 or 30 years worth of retirement to continue to rebound from that recession or rebound from that dip in stocks. And maybe your intention is to leave it for charity anyways, and you want to get the most growth out of it as possible. So again, these are just really general rules that I see out there that certainly are not applicable for everybody. So I would just want to make sure you kept that in mind. A few other thoughts before we get to maybe more specific items for this population, which is that if you've calculated those numbers for before, there are a lot of ways to make up the difference in retirement if you haven't got this $1 million or $2 million that my earlier figures told you that you need to have. A lot of these you've already heard. I think that this one right here gets sometimes discounted a little bit, working 2 to 5 years longer. It makes quite a difference. And if you think about, instead of withdrawing $50,000 or $60,000, $70,000 from your retirement plan, and instead making that amount of money, and maybe that's consulting or working part-time or just working wherever you are right now, it makes a huge difference in how long your money is going to last. And so, just working that extra 1 or 2 years, I would encourage you to look at how big of a difference that might make. Obviously, there's a lot of other things like downsizing, working in a less expensive area. We've talked about, reverse mortgages and whatnot, moving in with a family member. We've talked about delaying Social Security. That's definitely going to be adding some guaranteed income to your stream here. Renting, especially if you don't know if you're going to be staying in one place, there's a lot of costs that go into buying a house, and also a lot of costs going out of that house. And generally, I say you want to be around for about 5 years in order to break even on that home purchase. So if you're not sure you're going to be there for 5 years, I have a lot of retirees who rent right now, and that's perfectly okay. So just if you want to have a flexible plan, just know that there's a lot of options here to make up the difference. Okay. So maybe some of the more particulars that will be applicable to this audience, again, as you're really thinking about how is retirement going to go. I just have some notes in here that I want you to consider. And again, not advice for everybody, but just some ideas to consider. If you're in the position where you own a practice right now and you're thinking about selling that practice in the next 5 years, what I will typically see is that the best way for the practice owner to retire is to first live off of those proceeds. So let's just say you're a dentist and you sell your building and your practice for around $1 million. That $1 million is money that doesn't have to have any income tax on it once you've received it. Whereas you may have a 401k or an IRA, and as soon as you start taking that money out, you're going to have income taxes to pay on that. So we want to delay that or at least limit that as best we can. So typically a practice owner will spend the majority of their proceeds first. They will take a small amount out of their 401ks and IRAs to keep their income tax bracket low, or they may even start making Roth conversions, which just means that they're going to convert their IRA into a Roth IRA. That means immediately they have to pay income tax on that. But what we do is we, quote, fill up the bucket. If we're right under the 12% income tax bracket or even the 22% income tax bracket, we will convert enough of that IRA to just reach that ceiling and stay right under it. That way we've paid the least amount of taxes on that we can, and now we have this Roth IRA that can grow through retirement tax-free or be left to an heir, which I'll talk about in a second. So that's sort of the order operations for a practice owner. And obviously you'll need to consider what your income needs are. So if I need $100,000 a year versus $200,000 per year, that will change the equation of where these assets are going to be coming from. If you get through the whole financial plan and you find out that, again, you have more assets than you need, then you get to play a lot of fun games, in my opinion, to figure out where your money will be going, whether that's to a charity or whether that's to your children. That's going to dictate where these assets get put. So again, as an example, charities, you can donate low-cost basis stock and get a full donation and not have to pay the capital gains tax. So if you bought Amazon 20 years ago and it's sitting in a taxable account, and you're not selling it right now because you will pay 15 or 20% in capital gains taxes, that might be a good asset to donate directly to the charity so that way nobody has to pay that. Alternatively, if you're thinking about leaving that behind to your children, that asset, that Amazon stock, will get a step up in basis once you pass away. So if Johnny, your son, inherits the stock, they will not have the basis from 20 years ago. They'll have the basis from your date of death, which means that they can sell it immediately and not have to pay any capital gains taxes on it. So you can see that small decision there will really dictate what is the appropriate plan for that kind of investments, okay? And then finally, I just have noted here, if we're trying to leave money to our heirs at some point, after-tax assets are going to be really valuable to your children. Just think about your 30 or 40-year-old child who's making income and is in a high tax bracket. They're probably not going to want to have your IRA. They would rather have your Roth IRA. Your IRA, you will probably pay a lower tax bracket on that than they would, whereas the Roth IRA, they can take distributions from that and not pay any taxes on that at all because you've already paid taxes on that. So again, as we're trying to figure out which buckets to withdraw from, we just want to try and at least make some semblance of a plan, some outline of a plan to figure out what is the best way to not only stretch out our own withdrawals, but plan for our legacy and where these assets are going to end up. Okay. A couple of roadblocks I just want to bring up as well that, again, I don't know that everybody completely considers, and is one of these things that's really hard to address. But long-term care insurance has been a really tough thing for my clients to get in recent years. If anybody knows somebody who took out a long-term care policy back in, say, 2004 or 2005, they were able to get a very low rate. And this long-term care insurance, just so we're all on the same page, is what we would pay for you to go into a nursing home if you became disabled at, say, age 80 or age 85. Previously, people didn't live as long. We didn't have as great health care as we do now that might be able to keep somebody alive for a long time. So people have been staying in nursing homes much longer and entering them much earlier, frankly, which becomes very costly. So 10, 15 years ago, we could take out long-term care insurance to help with this. We'd pay a small monthly premium, and then if we ended up using it, they would pay for us to be in the private nursing home. But again, even today, now, those policies are much more expensive, And even when I try to put a client through a policy, it's very rare that they end up being healthy enough to get a policy. These insurance companies really got burned on these policies. They've raised their prices and still lost money on them. So long-term care insurance is probably not an option. I mean, you can look at it when you're age 50 to 60, but if you're already past that time, it's probably not going to be an option. So instead, we have to start setting aside money for this event that may or may not happen, but again, is likely to be a part of your plan. There's a statistic that says of all married couples at age 65, about 53% of them will have at least one spouse who goes into a nursing home facility for at least 6 months. It's something along those lines. So usually it's going to be part of the financial plan in some way, shape, or form. We've got clients that have been in a nursing home for 7 or 8 years. So this can be very expensive if that ends up being the case. So I just, again, want to acknowledge it because when I'm making a spending plan, typically we might take out around $200,000, invest it conservatively, and we're not using our withdrawal rate on that $200,000. It's completely separate of the plan. So we're not spending 5% of this asset as an example. So something to keep in mind. And then finally, a lot of our clients are retiring a little bit earlier if they can, if they've got the financial means. So that means that healthcare becomes a bigger issue at this point in time. Since Medicare only starts at age 65, you'll need to go to the Massachusetts Health Connector to get an individual plan if you're not qualified for COBRA or something else from your former workplace. And that, I'm sure you guys are well aware, can be very expensive, and we'll want to budget that into your spending plan as well. So just in closing here, I will say that more often than not, when I do a whole retirement analysis, people that come to me, if you think about it, people that select themselves to go to a financial advisor, they've done a pretty good job saving. They're in a pretty good place financially. But we just have to outline a lot of these kinds of things, these tax maneuvers, these changes to investments, these other eventual things that may come up, and just make sure they have the right plan in place so that way there aren't any mistakes or anything along the lines there. Some employees that I have or clients that I have may be relying on a pension of some sorts, and maybe they need some life insurance to take in place that pension if it doesn't come to fruition. So again, we just try to outline all these various scenarios to see what is going to be the appropriate plan and make sure that we don't run out of money and can have a retirement that is giving us some peace of mind, knowing that our assets are all in place and taken care of. Okay. So that essentially wraps up our presentation. I just want to note that our website here does contain a lot of resources, especially if we have any dentists in the webinar today. We've got a nice tab here that leads to a free ebook that you can sign up for. All you have to do is put your email address in there, and then we send it to you. It can be either in a PDF or a Kindle format. And this goes through a lot of the things I'm talking about. Actually, today's presentation really just talks about Chapter 13, which is pre-retirement planning. And I definitely dive into many more numbers in that chapter there. But you can see along the lines here, I talk about our foundation for our younger listeners today, accelerated wealth accumulation once you're in your 40s or 50s, buying a practice and getting that going, the things you should be thinking about. And then finally, once you're at the finish line, you're a year or two from retirement, selling your practice, getting your investment strategies in place, and then again, leaving a legacy we've talked about today. I'd say this book is applicable to a lot of different people. It doesn't have to just be a dentist that owns a practice. There's a lot of nice principles in here that are very applicable. So again, if you are interested in that, just head over to the fncadvisor.com, click on dentists, and then you'll be able to sign up for that ebook at the bottom, and I'll send that over to you. Otherwise, again, my contact information is going to be right here. I do write a blog if you want to stay up to date with some of these topics. You can connect with me on LinkedIn or shoot me an email if you have any questions over any of these topics today or anything in the future. And then finally, our phone number is here as well if you'd like to contact us. So again, thank you very much for joining, everyone, and look forward to talking to you soon. Take care.